almost all of it, all of silver, is related to industrial activity. And when there are fears about industrial activity and the fears of a possible recession, that's when I would expect gold and silver very definitely to diverge, because gold is not an industrial metal, even though it is. I mean, industrial uses are very, very small in the broader context of gold demand, whereas they are dominant in the silver business.
The environment is ripe for precious metals, especially gold, to continue to go higher. We'll talk more about this with our next guest, George Milling-Stanley. He is a chief gold strategist at State Street Global Advisors. Let's get his forecast for the mid-year and 2025 price outlook for gold, and we'll talk about the drivers of the gold price, importantly, inflation, interest rates, the dollar, geopolitical factors that all contribute to his forecast. Welcome back to the show, George. It's always good to see you.
Thanks, David. I appreciate the invitation. It's always good to see you. Look, the gold strategy team at State Street Global Advisors that I'm part of, we put our thoughts together for the remainder of 2024 just a few months ago, back in June. And what we felt at the time was that if things stayed the same as they were, and I'm talking here of things in the macroeconomic world, things in the geopolitical world, and also things within the internal market dynamics of gold, the balance between demand and supply. If things stayed the same, we were looking for gold to trade between 2,200 and 2,500. But if things improved for gold in any one or all of those various different spheres, if things improve for gold, then we could see a trading range between 2,500 and 2,700. And that's exactly where gold is at this point, somewhere above that $2,500 level. We're up 22% or so year to date. We've seen a succession of fresh all-time highs, and I think that we probably have more to come. We gave our base case, that 2,200 to 2,500, we gave that a 50% probability weighting. And we gave our bullish case a 30% probability weighting. So what we were basically saying was we were 80% confident that gold would stay where it was back in June, or it would go even higher. We're actually a little more conservative than an awful lot of people on the street. There are people talking about gold at $3,000 very, very soon. I'm not in that camp. I think that we probably will see $3,000 one of these days. I don't know whether it's going to be in 2024 or maybe in 2025. I think it's a very real possibility, but let's not get ahead of ourselves. Gold's done very, very well indeed over the last few years, and we still think that there could be more to come.
When you say that factors need to improve for the gold price to go higher or even just maintain its current range, which are these factors that are most important?
I guess on the macroeconomic front, we were looking for interest rate cuts. I think everybody's been looking for interest rate cuts for the whole year. If you cast your mind back to January of this year, we were going to get 7 rate cuts starting in March. And here we are, it's already September, and we don't have one yet. Now, we're expecting to get one when the Fed meets next week. I think that we're probably going to get a rate cut then, and we may well get more at the other 2 Fed meetings that they have during the remainder of the year. We expect the Fed to be in rate cutting mode for the foreseeable future until we get rates back down to the sort of levels that the economy does well on. What we have found, though, I think that on the macroeconomic front, I think there is still the fear that the Fed will keep rates too high for too long and possibly push the US economy into recession. Probably not very long-lived and probably not very deep, but it is something that worries investors, because that would mean a big drop in the equity markets, which I think would be worrying. So that I think is one of the things that the fear of recession is one of the things that has worked to help gold prices. I think that the fact that we're definitely going to get rate cuts if we take what Jerome Powell says at face value, what he said at Jackson Hole recently, and what he said subsequently. I think that it's right for investors to expect rate cuts. That generally is helpful for gold prices. And on the geopolitical front, I think that a couple of things. We still have this war in Europe with the potential to turn nuclear, and with everybody's attempts at trying to get peace talks started seeming to founder, and that the prospect of peace in that region just seems to get further and further away the longer we go. So I think that has been helpful for the gold price. The conflict in the Middle East started out being just within Israel's borders. It's now open conflict between Israel and Iran. That is a very, very worrying sign. And Xi Jinping is still making rather belligerent noises toward Taiwan. That is troubling. And of course, we have an increasingly ugly presidential election in this country. And I'm going to make you a prediction here, David. I think it's only going to get uglier in the next couple of months until we actually get to voting day in the US in November. So I think all of those things are what has pushed gold out of our base case and up into our bullish case, with the price looking pretty good above $2,500 an ounce.
I'd like to take a minute now to talk to you about a great way to buy physical gold through a trusted dealer. Our sponsor today, One Gold. Launched by trusted industry leaders in APMEX and Sprott, One Gold allows you to own vaulted gold, silver, and platinum in your choice of secure vaults around the world. With One Gold, your holdings are fully insured, audited, and IRA eligible. One Gold is an intuitive and secure alternative to precious metals ETFs and offers an array of unique investment tools like the bullion card, auto invest, limit orders, and more. Thousands of customers are using One Gold as a complement to their physical assets using their regular at-spot promotions. Additionally, One Gold offers unparalleled liquidity with same or next day cash withdrawals, 24/7 trading, and physical redemption. Get started today with a few clicks from onegold.com, link down below, or scan the QR code here, or by downloading the One Gold mobile app in the Google Play or App Stores. We talked about the bullish cases in the base case scenario for gold, which would be slightly higher, if not the same range. What would, in theory, drive the gold price much lower? Let's say below $2,000 sometime next year. What would need to happen, hypothetically?
With the current environment that I think is very favorable for gold. We would need an outbreak of peace all around the world. We would need, resolution to the conflict in Ukraine, resolution of the conflict between Israel and Iran. We would need Xi Jinping to back off from his territorial ambitions toward Taiwan. All of these things would have to happen. I think we would also need to see the dollar turn around and start to move back up again, and to get beyond those 20-year highs and go up to 30 or even 40-year highs against other currencies. That's very hard to see, especially if the Fed is going to be in sustained rate cutting mode. We would need to see the US economy go from strength to strength instead of actually starting to suffer as well as we're seeing in recent months. I think an awful lot would have to go wrong with this picture. And I think it's very difficult to see prices dropping below 2,000. We spent 5 or 6 years with $2,000 as a very, very strong overhead resistance. Every time the price poked its head above the $2,000 an ounce level, speculators took profits, and then they bought back in again a few $100 lower. I think we made a decisive breach of that $2,000 level earlier this year. We touched on it at various different times, but I believe we made a decisive breach of that $2,000 an ounce overhead resistance. And as you know as well as I do, David, when overhead resistance is broken, then it generally very quickly becomes downside support. So our bearish case for gold still didn't see gold dropping below 2,000. We thought gold might, if everything went wrong, gold might trade between 2,000 and 2,200. But it's difficult to see gold going back down into the below $2,000 territory that it had spent 5 years getting above.
Can you just maybe give us a quick history lesson as to why gold back in 2011, post 2011, fell back down to $1,000 an ounce after reaching its highs of $1,800, almost $1,900 in 2011?
I think that that period was really the start of this especially benign period for the economy, and the recovery from 2008 gathering pace. So it was a benign period for the US economy. It was a benign period for the US stock market. I think that that was probably the two major headwinds for gold at that point. Gold traditionally offers protection plus performance. And people decided they did not need protection when the stock market was going up and everything in the economy seemed wonderful. Then I think that people decided they no longer needed to pay for protection. I think the reason why gold is going up right now is that people have seen the need again. They're recognizing the need again to pay for protection. And with gold also performing at the same time, then it's an easy decision for people to make.
I want to switch over to my screen here and take a look at the gold chart. And what we're going to do, George, is I'm going to overlay it with a few variables that have traditionally been closely correlated or maybe inversely correlated with the price of gold, starting with the dollar. I'm going to overlay this with the DXY, which is the dollar measured versus a basket of other currencies. And over the course of the last, well, 9 months year to date, what we've seen is that there have been periods where the gold price and the dollar have been inversely correlated, as has historically been the case. There's been this, I would call, rather odd period between Q1 and Q2 when they've been positively correlated, and now they're diverging once more. How can you explain this back and forth between positive and negative correlation all in 1 year, George?
Yep, that relationship is a tricky one to understand. I think, for most of my career, which goes back 50 years, we've looked for less inverse correlation. Nothing is ever one-to-one, but we've looked for a more or less inverse correlation between gold and the dollar. But I think a lot of things changed in 2008. And what I believe that we've seen, if you were able to put your chart all the way back to 2008, is that when the dollar's going up, gold can go up, down, or sideways. It has done all three at various different points in that 16-year period that we're looking at here. But every time the dollar has turned down, then I think gold has gone up. So instead of an inverse correlation with gold and the dollar moving in opposite directions, when the dollar's going up, gold, as I say, can correlate with it or not, depending on how it feels. But the inverse correlation certainly comes into play whenever the dollar has shown signs of weakness over that 8-year period. So we have an asymmetrical relationship rather than a simple inverse correlation. Asymmetry is often hard to understand, but I think that it's an important one that we get this relationship as correct and clearly as much as we possibly can.
Yeah, to your point about what happened in 2008, the last great financial crisis, the dollar saw weakness over the coming years from 2009 to basically 2014. The dollar here is represented by the purple line, and gold, as you know, continued to spike up to its high in 2011. So negative correlation there. It seems to me that during periods of crises, what we see is a weakening of the dollar and a flight to safety into a hard asset like gold. Is that a good summary?
That makes perfect sense to me, David. Yep, that's exactly the way that we see the relationship between gold and the dollar.
It's interesting, however, just in again last couple of months here, both the price of gold and I guess the strength of the dollar has been relatively consistent. Is this relationship not signaling a crisis coming up? If we can read into that at all?
You know what? I'd love to say that I had a crystal ball, David. I don't know whether there's a crisis coming or not. I am concerned about the possibility that the Fed might keep rates too high for too long. There's an awful lot of people who believe that what's required right now is at least a 50 basis point cut next week and further cuts during the remainder of the year. The markets would certainly love to see that. I don't think that Jerome Powell is necessarily going to give the markets what they want, because he is still concerned that inflation on his preferred measure, personal consumption expenditure, is still running at well above the 2% target that he set himself. And that's in spite of raising interest rates to 20-year highs. So I think that he's still very concerned about that rate of inflation and just how sticky it is. I don't think the markets are anywhere near as concerned as Jerome Powell at the Fed is, but nevertheless, there is always the possibility. It was obviously the right thing to do was to cut rates in 2008, but they kept rates at zero for way too long. 13 years later, it was clearly the wrong thing to be doing. Raising rates, as he's done over the past few months, has obviously been the right thing to do. But the fear is that he will be too slow to act, just as he was with zero interest rates. He'll be too slow to act with higher interest rates, and he'll keep them too high for too long and possibly tilt us into recession.
Let's talk about the possibility of a recession. There has been signs that the labor market is weakening. So, monetary policy aside, do you agree with the analysis that I've been hearing that some of this weakness in the labor market is just a lead up to a broader, I guess, more pronounced series of layoffs in certain sectors and higher unemployment?
Yeah, I think that there are all kinds of structural changes going on with my generation, the baby boomer generation, moving into retirement, most of us. And I think that has meant a significant reduction in the size of the labor force over the last 20 years or so. That I think is now coming to an end. It's really very, very hard to get a consistent read on the labor market. And of course, the numbers that come out, almost all of them seem to have to be heavily revised the following month. So it's really very, very difficult to keep to keep the right kind of attention paid to that statistic. But I think it's pretty clear there are some troubling signs of weakness in the market, and I think that's why the Fed is probably set to cut rates next week. Whether that will be enough to address those weaknesses, I don't know. We do have one more set of employment statistics to come out before the Fed actually has to make its decision next Wednesday, and I think that could be pivotal. The other thing that could be pivotal is the consumer price index. It may not be Jerome Powell's preferred measure, but it's definitely something that he keeps a very close watch on. Consumer prices are due out over the next day or so, and I think that could be important as well. The combination of the CPI report and the next labor market report, I think, will be pivotal and directional for what Jerome Powell does next week.
Generally speaking, are we going to see more disinflation, meaning low inflation in the economy for the next foreseeable future? Or do you think rising deficits may portend higher inflation or a return of higher inflation?
Yeah, look, I think that inflation is still very, very sticky. We've gotten the PCE number down from a high of 5.4%, but it's still at 2.5%. That is still way higher than Jerome Powell wants it to be. The first couple of percentage points are always the easiest thing to do. The last 0.5% is proving very, very difficult. And I think that's going to color Jerome Powell's judgment very, very much. Inflation is sticky. I think there's no question about that. A lot of people have focused on what happened with headline consumer price index, which has come down from over 9 to just over 2. And everybody thinks that means we've tamed the wild beast of inflation. I'm not confident of that. And I know Jerome Powell isn't as confident as an awful lot of people in the markets are that we have finally finished with inflation. So he is going to remain, he keeps promising higher for longer than anybody expects. And I don't think he's going to raise rates. I don't think there's any need for him to do that. But I think he is probably going to keep rates high for a while yet.
And on the dollar, we talked about the dollar's relationship with gold. Let's talk about the direction of the dollars. There's some people who say that a Fed cut would be, I guess, bearish for the dollar, meaning the dollar would weaken. Another analysis is that, or opinion, is that other central banks are also cutting rates. And so if you factor in rate cuts from the Bank of Canada, a weaker economy from the ECB, right? Bank of England has cut, for example. Now there's speculation the Bank of Australia. So the Fed is not alone, meaning the DXY is a basket of other currencies. It may not necessarily weaken as much. What do you think?
Look, I think that when other people cut rates at the same time as we do, then obviously that reduces the impact of the rate cuts that we make. But on the broader view, if you think about this, a couple of years ago, I think that the Fed felt that the markets were not taking them seriously. So instead of raising rates, they were still in rate raising points in 2022. Instead of raising rates by 25 basis points, the Fed raised rates by 75 basis points at each of 3 consecutive meetings. I think this was a way of trying to persuade the market that Jerome Powell was serious in his message of higher for longer. What did that do? That drove the dollar to a 20-year high against just about every other currency in the world. And what many of us in this business have been looking for ever since those rate increases drove the dollar to a 20-year high in the fall of 2022, we have been looking for a reversion to the mean. We've been looking for other currencies to get stronger against the dollar, and we've been looking for the dollar to weaken against those other currencies. And in this particular aspect, gold frequently behaves as a component of the currency market. It did in 2022. Those interest rate hikes were a headwind for gold. They didn't push it down, but they stopped what had been a rather promising environment of gradual increases in the price in early 2022. And the gold price ran into a brick wall when the Fed raised rates like that, and with the impact that it had on the dollar. Now, many of us have been talking that we should be expecting to see a return to the mean. I don't think that we have seen much in the way of weakness in the dollar just yet, but I do expect to see weakness when we get the reality of rate cuts, especially if the Fed makes it clear that it is definitely setting out on a course of sustained rate cutting, and that's what I'm expecting that Jerome Powell might feel bound to say next week. Again, I'm not going to try to second guess him. But I think he's made it clear he's probably going to cut rates by 25 basis points, 50 basis points that some people have asked for is unlikely. So we're going to have to wait and see what the Fed does. But I think the reality of rate cuts, even if other central banks are continuing to cut along with us, I think that the dollar is still unusually high against most other currencies. And I think that that's a situation that will come to an end at some point, probably when the Fed embarks on a sustained round of rate cuts.
I hear sometimes that the gold market is a good hedge against volatility, and in certain periods that certainly has been the case. However, if I were to overlay this with the S&P 500 and just take a longer term view, you can see, George, that just take the last 5 years, for example, they've more or less grown together, the stock markets and the gold price. If you take a look at an all-time view, that relationship is even more pronounced. Let's just take a look at the last 1 year, for example. We've seen again the S&P and the gold price moving up more or less together. More of a divergence now. The stock markets have been going down since the beginning of July, August really, and the gold price has been holding steady. Again, any reaction to this particular divergence? Is this normal?
Yeah, look, I think that the relationship between gold and the equity market is very, very similar to the relationship between gold and the dollar.
Mm-hmm.
That when the equity markets are going up, then gold can go up, down, or sideways. We've seen times when it has done all three.
Sure.
And we've had a pretty unusual state in the markets just this year already. It's only a few months since the S&P 500 was setting a succession of all-time highs, gold was setting a succession of all-time highs, and Bitcoin was setting a succession of all-time highs. So there you have the equity market, which I would regard as a risk-on asset. You've got Bitcoin, which I would regard as very much of a risk-on asset. And you've got gold, which I would regard as definitely a risk-off asset, and probably the best risk-off asset that there is, all doing the same thing, which seems counterintuitive. I think the issue here is that a number of investors, seeing the enthusiasm for risk that the markets were displaying, whether it was in the equity markets or in the crypto business, there was definitely an enthusiasm for risk in mid-year, middle of this year. And I think that a number of people felt, well, if this is a risky venture, so maybe this is a good time, even while we're buying gold, buying equities and cryptos. Maybe this is also a good time to up our exposure to the ultimate risk-off asset, which I would regard gold as. And I think that's probably the closest that we can come to an explanation.
Uh,
As for the relationship between gold and equities, as I say,
yeah.
it is different from the one that I grew up with, and I think that we just have to uh, watch and wait and see whether an inverse correlation does develop or whether we continue to have this rather odd asymmetrical relationship.
It's different from the one you grew up with. What can you elaborate on that? How was it before?
Yeah, look, I think when I started out in the gold business just a little over 50 years ago, I think one of the, we looked at a couple of things when we were trying to figure out where gold prices might be going. We would look at what was happening with inflation. We
Hmm.
would look at what was happening with the dollar. We would look at what was happening with competing assets like the equity market. And for the most part, we expected a strong correlation between gold and inflation. And we expected an inverse correlation between gold and equities and between gold and the dollar.
Hmm.
And as I say, I think that things came a little unglued in 2008. I
Hmm.
don't know whether we're ever going to go back to the situation
I see.
before as it was before 2008 or not. But some of those eternal verities that we used to look at when we were looking at gold don't seem to apply anymore. So I think we have to look for other things to try to explain the likely behavior of gold.
Another curious thing that precious metals investors will like answers to is gold versus silver. So here I've overlaid gold with the silver price. And you would expect these two to more or less move in tandem for the most part. Again, more or less a divergence starting in around the same time that the stock markets have been diverging from gold, gold holding steady and the silver price going down. I'm just wondering if this is this gold price behaving um, abnormally, or does this make sense in the context of the broader macroeconomic environment right now?
I think that the what you said last that makes sense in the context of the broader macroeconomic environment.
Hmm.
There's a growing realization that there is not necessarily a logical connection between gold prices and silver prices. Gold has very diverse sources of demand. Industrial demand for gold is less than 10% of the total. Jewelry is easily the largest single source of demand. Investment is large. Central bank demand over the last 14, 15 years has been a very, very significant component as well. So very diverse sources of demand. Silver is very different. Silver, I would expect silver to behave much more like copper
Hmm.
because silver is almost entirely consumed in what I would call industrial applications. What do I mean by that? Most of silver is used in high-tech imaging for scientific and especially medical purposes. It's used in pollution control. It's used in water filtration. It's used as a bactericide. Silver does lots of very, very amazing and very useful things,
Hmm.
but almost all of it, all of silver, is related to industrial activity. And when there are fears about industrial activity and the fears of a possible recession, that's when I would expect gold and silver very definitely to diverge because gold is not an industrial metal, even though it is. I mean, industrial uses are very, very small in the broader context of gold demand, whereas they are dominant in the silver business. Silver
Yeah.
jewelry is a really small part of the silver demand, and silver investment an even smaller part, whereas both of those are very, very important and dominant in the gold market. And because of that, I think that's why we're seeing a major divergence here in price performance.
That's an excellent point. And to your point about how they've usually stuck together in the past, that's been the case. I'm just scrolling back now to 2022. It's now the first time I've seen that we're seeing some sort of divergence on the scale. So perhaps it's signaling a global slowdown, this divergence. And to your point about copper, I've actually looked at this, and you're right. Copper has behaved very similarly to silver this past year. This is the copper price in the bar chart, and the silver line remains the purple line. And yeah, you're absolutely copper and silver have had a very, very close correlation this past
Yep.
year and the prior years as well.
That makes
Um,
sense. Copper is almost entirely, I mean, copper is entirely consumed in industrial applications.
mhm.
Silver is mostly consumed in industrial applications. So that's the kind of price profile that I would expect to see. It's useful to see it up on the screen, David. I really appreciate you doing that.
Yeah, it's Definitely makes a lot of sense to support your thesis. Okay, over the last year, the World Gold Council has reported that over the last year, there's been a surge of demand from China on gold and gold products. Have you noticed any shifts from that pattern in the GLD demand profile, or have you noticed more or less the same thing that Chinese and Asian investors are driving a lot of the demand for GLD and precious metals
No,
and
I think that
physical? Yeah.
no question the World Gold Council got this one right. Um, when we put our mid-year outlook together at State Street, we cited Chinese demand as being one of the three major drivers. Central bank demand that I touched on briefly just a little while ago was also cited as being very important for what had happened in the year to date and for what we expect to happen over the next 6 to 18 months. So Chinese demand, central bank demand, and a revival in Western investment were the three things that we put as the major drivers. As far as the Chinese demand is concerned, I think a lot of Chinese investors were seriously worried about the real estate problems that have been plaguing the Chinese economy for years now. Um, and I think that those problems in the real estate sector started to spill over into the banking and financial sectors. And what this means is that the Chinese investor is essentially running scared of his own stock market, and he is looking for alternatives. Gold traditionally has always been one of the alternatives that Chinese investors turn to. They are buying gold ETFs, locally made ones, for the local consumer and those with access to offshore accounts, buying the international gold ETFs like GLD that you mentioned. That has been a huge factor behind what I call this gradual revival in investment demand. I think that's been very, very important.
Are you expecting central bank buying of gold to remain strong? Do you have any insights on that?
Yeah, absolutely. I think we've seen a very long-term trend and a rather shorter-term one. The long-term trend is that central banks, especially central banks in the emerging markets, have realized that their official reserves are overweight in dollar-denominated debt instruments, with more than two-thirds of people on average for emerging market central banks in dollar-denominated debt, and that they are underweight in gold with less than 5% on average. And I think that there's been some selling of US debt. There has definitely been considerable buying of gold over the last 14 straight years, with central bank buying accounting for anywhere between 10 and 25% of end user demand in those 14 years. I think that's set to continue. We saw for the first half of this year, when the World Gold Council produced statistics recently, we saw an all-time record for any first half in history. So I think that strong central bank demand from emerging markets is definitely set to continue. And then a couple of years ago, when the US government decided to, as some people call it, weaponize the international payment system by excluding Russia from SWIFT, I think that gave a number of other countries pause, countries that either have upset us in the past or are contemplating upsetting us in the future. And I think all that did was simply sparked even more central bank buying than we had seen over the previous 15 years. So we saw an all-time record in 2022. We came within about 1% of matching that all-time record last year. And as I say, we've already had a record first half in 2024. So central bank buying, I think, will definitely continue because those imbalances remain. They still have more US debt than they want, and they still have nowhere near as much gold as they would like.
George, I really appreciate your updates. Very thorough as always. Where can we learn more from you and your work?
You can look at the work that we do at ssga.com. I think it's fairly easy to find the various things that we write about gold. And it is a team effort. It's not just me, but there's a team of several people. And there's a wealth of information there. And of course, I would always recommend that people take a look. If they're looking for supply demand information, then take a look at what's on the World Gold Council's website at gold.org. So ssga.com and gold.org, I think, would be two very, very useful websites for people to take a look at.
Thank you very much, George. And thank you for watching. Don't forget to like and subscribe and follow George and State Street in the description down below.
David, thank you for the opportunity.